Good afternoon. This is Bakes, Kevin Baker. It's Saturday the 21st, and this is a special show. I have my third guest. My first two are near and dear to my heart, my sons, Bobby and Jack. And we have Matthew Tuttle from Tuttle Capital Management. If that sounds familiar at all, it's because I've been as subtle as a 2x4 talking about SOGU, their short SPAC ETF, which I'm a big fan of. It isn't all they do, but it'll be a topic of the conversation. But Matt, thanks for coming on and welcome to the show.
Thank you for having me.
We talked a little bit about this, and I did some research on my own, but very quickly, give me your path, what you did before, how you founded Tuttle, or how Tuttle found you. Please enlighten us.
So, it started off at a bunch of different brokerage firms, was horrified by what passed as financial advice, kind of thought maybe insurance companies would be better, went to a couple of those, was equally horrified what passed for financial advice. Someone gave me a book on how to start your own RIA in 2003 and jumped at that, and kind of was running my own wealth management shop for a while. Started having, other people come to me and ask if we could be kind of their outsourced chief investment officer, which, the investment side has always been my passion. So I said, yeah, we'll do that, and set up a money management company to do those things. Fast forward a couple of years, ended up getting rid of my wealth management firm, giving it to one of my clients, focused entirely on the money management side. In 2015, started launching ETFs. And then at the end of last year, we started having other people come to us who, wanted to launch ETFs and wanted to partner with someone who, knew how to do it. And we started doing that as well. So, we're kind of sitting here. We've got a bunch of our own ETFs now, and we've got a bunch of ETFs for other people that are in various process of launching and filing.
Is everything that you sponsor now your own created ETFs at this point in time?
Everything that we have, right. Everything we have out there now, yes, it is. We've got an ETF coming out on Tuesday, and another 3 coming out next Tuesday. ETFs we launch for other people.
Okay, so yours is Tuesday, and then everybody else is coming up after that.
No. So that's somebody else's is Tuesday. So that's a firm called Revere Wealth Management.
Okay,
we're launching an ETF for them on Tuesday.
Can you share with us what that is and what the focus is?
Yeah, so the company's Revere Wealth Management. It's called the Revere Sector Opportunity ETF. The symbol is RSPY. And basically what they do, it's run by a guy named Scott Fullman, who's, a genius, all the different C, designations. They start off with, kind of the select sector spider weights of the S&P 500. And then he's overweighting or underweighting based on a bunch of different things, macroeconomic, fundamental, technical. So, he can be totally out of a sector, he can overweight it, he can underweight it, and it's buying the select sector spiders.
Fantastic. Talk about, I obviously talk about SOGU, the DSPAC ETF, the short ETF, and if you followed me on social media, I've been relentless. I talk my own book, but I admit it. But tell me about what else you do, and then we'll segue into SOGU, please.
Yeah, so our largest ETF is SPCX, which is our pre-merger SPAC ETF. So it is the first fully pre-merger SPAC ETF to be launched. We launched it in the middle of December. It's got somewhere close to about 100 million in it. So we've got that one. We also have FOMO, which we just launched a couple of months ago, which is, basically what you would expect it to be, the meme stock, some of the innovative technology, things that are set up for a short squeeze, with the Apples and the Amazons and stuff of that nature. We have Fat T, which is it's designed to be positive carry tail risk. So the idea is we want to be able to make a little bit of money the 99.9% of the time the market's going up. But then when the market gets crunched and really, like a COVID or 2008 type of deal, we want to be able to make about as much on the upside as the market makes on the downside.
How do you do that, please?
So we do that. It's complicated, but basically what we're doing is the portfolio is mostly made up of index ETFs, so SPY, Qs, and the diamonds, and volatility ETFs. And we ramp up and down, could be daily, the amount of volatility we have versus the index funds. So the idea is we always want to own some volatility. And the volatility, again, 99.9% of the time is going to bleed. It's just going to go down every single day, like Chinese water torture. So the idea is we have the index funds in there to offset that bleed when the market's going up.
Okay.
When the market gets killed, volatility spikes. So for example, at the height of COVID, these volatility ETFs were up 300% at a time when the market was down 30. So the idea is, in a COVID type of situation, we would be ramping up how much volatility we own so that, we're not going to be up 300%, but the idea would be markets down 30, we want to be up 30. And then things go back to normal. We ramp down to kind of our base case, which is typically around 10%, 10% or so in volatility.
Okay. You don't buy long-term leaps?
No long-term leaps. We developed a treasury sleeve that we may end up putting into it, but I'm not going to put it in here. I'm not a big fan of treasuries at the moment, so I'll wait for them to get crunched, and we might add those in. But at this point, no, nothing on the option side.
I got to ask you, I was watching Barron's last night. The Michael Burry, Cathie Wood debate comes up, and the first thing I do when I hear something like that is say, is there a way to participate? How do you short ARK, the ARK Innovation Fund? Tell me your thoughts on that, please.
Well, so yeah, and I'm sure you and your viewers know, we filed a couple of weeks ago for SARK, which the idea behind that would be to give the inverse exposure of the ARK Innovation ETF. Can't obviously talk too much about it because it's been filed. It hasn't been approved. You never know whether it will be approved. But the idea is, in nothing against Cathie Wood in any way, shape, or form. I mean, we've got tremendous respect for the guys at ARK for what they've done. But what's interesting is if you look at the landscape of the major sectors, the major industries, the major indexes, there are long and there are short ETFs for those, because everyone's going to have a different opinion, a different thing they're doing in your portfolio. Sometimes you may want to be long technology. Sometimes you may want to be short technology, and you've got the tools for that. What ARK has done, to their credit, is they've created an entirely new sector, for lack of a better word, and I think Goldman Sachs referred to it as unprofitable tech, which, I guess isn't my favorite description because, it wasn't developed by a marketing guy who wants to buy unprofitable tech. But until someone comes up with something better, Jim Cramer had Woodstocks. I maybe like unprofitable tech better. There's no way to short unprofitable tech, because unprofitable tech, if you look at it, is not correlated with profitable tech. Your Apples and your Amazons and, all that stuff. So we're just providing a tool. Hey, if you want to go long unprofitable tech, buy Cathie Wood's funds.
Yeah.
Nothing better as far as I've seen out there. We're giving you a tool. If you want to go short unprofitable tech, that would be, that's what we're trying to do there.
Ballpark timing on that, please.
If it gets approved, middle of October.
Okay, terrific. I will keep an eye on that, certainly, and I'll let our audience know. Talk to me about flows and what you see, what that tells you about investor sentiment right now, given the other funds that you have, please.
So the biggest stuff we're seeing is we're seeing outflows from our pre-merger SPAC fund, and we're seeing inflows into SOGU. And that tells me
you're welcome.
Yes, thank you very much.
I've done my part, believe me.
Beautiful. So, but that tells me a couple of things. So unfortunately, when we launched our pre-merger SPAC fund, SPACs were in a bubble. And investors, I think individual investors were looking at pre-merger SPACs same way they look at meme stocks, where, hey, I can buy this pre-merger SPAC. And, and they saw it with Churchill, CCIV, that thing went up to 66, which is just, it's insane. I mean, $10 in trust and it's trading at 66. So they're looking at these things like meme stocks. And then the bubble burst, and and the retail investors left, and and I'm pounding the table saying, well, wait a second, pre-merger SPACs are not meme stocks. Pre-merger SPACs are an event-driven strategy that is uncorrelated from stocks and bonds. That's what you should be looking at this stuff as, kind of like, for decades, investors have used things like merger arbitrage strategies as an event-driven strategy. You put 10, 20% in your portfolio, and it's not correlated with stocks and bonds. And the problem is those things make 2, 3, 4% a year. And, I looked at, one of the big merger arb ETFs during the COVID crisis, it was down 20%. So what I'm trying to pound the table on is, look, pre-merger SPACs are not a meme stock. You're not going to buy it at 10, it's going to go to 66, but this is an event-driven strategy. It's non-correlated with stocks and bonds, and that just hasn't caught on yet, unfortunately. And you've got all this stuff trading in the nines that is $10.15 in trust. And what you are starting to see is the yield guys realize, wait a second, I'm getting nothing on, on my bonds, but I can get a 2-3% or more yield to maturity on a pre-merger SPAC and still have the optionality if this guy puts together a good deal, to get a pop. So we're seeing rumblings of that. So that's good. And, the money going into SOGU, I mean, you see it, these D-SPACs, they're getting their butt kicked. And, people want to short these names, and, but you don't want to short these individual names. I mean, we own Clover Health and SOGU, a month and a half or so ago, Clover Health was up like 100% in a day.
Right.
I mean, God forbid you're short Clover Health on that day. That's a very bad day for you.
So in SOGU, you're short Clover, CLOV. You don't own it, you're short it.
SOGU, we are short Clover.
Okay,
that is part of the index.
Got it.
Yes.
Talk to me about that. How do you pick the 25 stocks that you're short in SOGU, please?
So it's 25 of, not the, 25 of the largest companies that have come public through a SPAC merger with a 12-month look back. So the 12-month look back is important. We want fresh D-SPACs. We want companies that have just come out. Wall Street's not covering them yet. They're not in any other funds that you own. So, they're totally and completely different. So like, DraftKings, that fell out of the index a couple of months ago.
Okay.
And to me, with good reason. I mean, DraftKings is more of a mature type of company now. It's probably in a bunch of different ETFs and mutual funds at this point. And we want the fresher stuff.
Okay.
Why we don't just pick the largest? A couple of reasons. We want to be somewhat diversified by industry and sector. But what we're also looking at, we're getting feedback from our counterparties, is there a stock that is basically impossible or near impossible to borrow? Because if it is, I can have it in the index, but if I can't get borrow on it,
Yeah.
it's not going to be in the index. So it doesn't help anybody. So we want to make sure we've got 25 names that we can actually get inverse exposure to.
And you adjust monthly. Do I have that right?
We adjust it every month. Yes.
What are assets in SOGU right now, please?
They're at about 23 million, a little bit above 23 million right now.
Maybe you can comment on this. Maybe you can. What's it cost to do, or what did it cost when you originally shorted Ride and Nikola, please?
So and quite honestly, I don't know. It changes a lot of times on a daily basis. So it's all different. It's all based on supply and demand. There is certainly, a cost built in. So, I mean, which is why we have it listed as an actively managed ETF, even though the SPAC index is an index, there's going to be tracking error. And most of that tracking error is coming down to the cost of the swaps.
Sure.
But it's changing every single day. The counterparties are coming to us, or almost every single day, with a new cost to borrow.
And this is your index, right? It isn't somebody else's that you adhere to. It's your own constructed index.
Right. We created the index. It's called the SPAC index. Anyone who has a Bloomberg can see it. We make the members public. We want, most people who create indexes, you can't see the members. We want people to be able to see the members. We want you to know, hey, these are the names.
Do you rebalance monthly to get them close to 4% a piece, or?
Yeah, the idea is we bring them back to 4%.
Okay.
And we do that because, as you can imagine, this gets out of whack. Really on day one. The way these names move.
Right.
So, unlike maybe some indexes that may not, if they're not making changes, we definitely have to rebalance, or else we'd end up all sorts of whack.
Gotcha. As we talked about on the ride over here, my sons are 24 and 23. They're the reason I do this. The Prudentials and the Payne Webers aren't talking to them, and if they were, they would probably give horrible advice, frankly. And so I cut into the void. I'm as subtle as a 2x4 most of the time. But I know you dropped your son off at Indiana. Did I get that right? Hoosier?
Yeah, my youngest, just dropped him off in Indiana last week.
So this is going to be helpful, and this is my prism, is, what life and or investor advice would you give to your son, your Hoosier, and my sons in our audience, if anything springs to mind?
Well, yeah, and we're somewhat in the same boat. I have a 23-year-old daughter and another 22-year-old son. And, so it's really a couple of things. On the financial front, the conventional wisdom is not necessarily wisdom. Just because someone is out there saying something does not make it true. And if the conventional wisdom was wisdom, the Forbes 400 would be like the Forbes 40,000. There's a reason that it isn't. So, that's number one, do your homework. Just because I'm out here saying something, or someone's on CNBC, or somebody writes a book about something, do your own homework, do your own research, and, do what makes sense to you. The other thing, I tell my kids all the time, learn how to think. You come out of college, you go into a job. I see it all the time. These kids are really good at doing what they're told to do, but they don't know how to think. They don't know how to say, all right, why am I doing what you're telling me to do? What's the big picture of what I'm doing? And if you don't ask those questions, if something is out of the ordinary, you don't know it. If something is wrong, you don't know it. And you really, you're not that valuable out there in the working world unless you can think.
Yeah.
And I just see that as such a big problem these days that, that's what I'm telling kids all the time.
I really appreciate that. How can our people, our audience, reach out to you? What's the best way to follow you, maybe on social media? Tell us how people can do their due diligence on your many ETFs that you offer, please.
Yeah, so I mean, our website is tuttlecap.com. I'm on Twitter at TuttleCap. I just learned how to use Twitter like 3 months ago.
Oh, so you're behind me. You're the one guy behind me. Welcome to the Luddites.
Yeah, pretty much. I mean, yeah, I'm 52 years old. Didn't even I had invested in Twitter, obviously, in the funds, but really didn't understand it until about 3 months ago. So I'm on that. I'm on LinkedIn as well. Still working on figuring that out, one thing at a time. So we're on those two things as well.
Okay. We'll learn together. I'll obviously share this. I'll put this all in the show notes. I really appreciate it. I'm fascinated to see about SARK, and I'll be on top of that. And I'll follow you on Twitter to do that. And I'll alert.
Keep an eye out. There's another thing we're working on. Logistically, I'm not 100% sure it's possible, but I think it is. So if it is, I would assume we'd be filing for it in a week to 2 weeks.
Okay. Yeah, that's all you can say?
That's all I can say right now, but it will be a very interesting idea if we're able to get it off the ground.
Well, that's a tease, as they say in the TV business. Hey, great meeting you. I really appreciate this. I appreciate SOGU. We're going to talk about it on the main show. I'll let you go. Thank you very much, and I'll talk to you soon.
All right. Thanks for having me.
Take care, my friend. Bye-bye.
All right, bye-bye.